Good afternoon, everybody. Thanks for coming along to this afternoon's Property Investment Store Supavest combined session this afternoon. Looking forward to being able to present some really good information to you all. We've got hopefully Raymond is there today, and hopefully he'll be joining us very shortly. He's from Supavest, and he has some great stuff to talk about Supavest and what they can do in helping clients unlock their self-managed super fund money and invest in a single contract property, which is a very tricky thing to do because normally you can't do that. Just to give you a bit of background while we're waiting for others to join, Property Investment Store. I've been in the industry in investment property and finance for over 28 years now myself, and it's a great industry. It has its ups and downs, no doubt about it, as we all know. But you know, I am trying to find ways. I'm trying to find ways that can really help investors get ahead. And I do have a bit of a motto, and Raymond has a very similar motto to myself, which is with our investors, is that if they're winning, then we're winning, and that's always a good thing. I can see Raymond's online now. Hey Raymond, how you going?
Anthony, very well. Looking forward to the day.
Yeah, no, thanks for coming along, and we've got a few people on there. There was a few people more coming, so we might wait another couple of minutes just to sort of before we get stuck in, but maybe just give everyone a bit of a brief about your background and where you've come from and just the Supavest side of the world and what you're doing there.
Yeah, excellent. If you go back far enough, I started out in Queanbeyan down next to Canberra, and I started selling real estate in my late teens, early 20s, and hated it. Got out of it. I was selling in North Lyneham. Back that stage, it was a greenfield site, land and house packages. Did it for several months, hated it after getting my qualifications, and then a couple of weeks after I quit, I moved to Sydney and became a trainee accountant in the chartered office in North Sydney. And for the next 16, 18 years, that was my life as an accountant. Then I had a motorbike accident, got out of that, had some head injuries, couldn't do accounting anymore. Did a range of other businesses, including youth and disability services, and into docs and DATIC and working with them 20 odd years ago. And then in a shop fitting some demo, and then about 6.5, 7 years ago, got back into real estate, selling land and house packages to accountants and financial planners and investors that were looking at new packages. About 3.5 years ago, then I came up with the Supavest solution when I was confronted by two friends that had purchased 2 NDIS properties off of us, one each, under untitled land. And 6 months later, it was January 2020, they came back to me and they said, Raymond, we want to put these into a self-managed super fund. Now, back then, unfortunately, those two deals didn't go ahead because building inside of super funds with debt is illegal, still is today, except through Supavest, where we have the solution to be able to now have people build whatever they want in their super funds, and especially NDIS is an amazing product to do that. So it's a big transition over the last 3 years, being able to really change the market and change how people are generating their wealth and actually looking at generational wealth and how they're looking to retire by using their superannuation funds to build high quality cash flow properties. And that's what we'll be going through a bit today as well.
Yeah, no, it's good. That's why I wanted you to come on today. I thought it was good just to let a lot of the guys understand and girls understand a bit more about how we can utilise that. I think, you know, we know we've got a great NDIS product. We won't go into that today. Obviously, today is to focus on really just the subject we're going to focus on today. But we know we've got a good NDIS product. We know we've got good solution. You know, and we know we've got a great product, which if it was able to be purchased in a super fund, you know, is a very powerful product for people to invest in, because obviously the returns are good. We know we can get the returns because we own our own property management business for the NDIS STA homes, and you know, being able to get those excellent returns for clients is exactly what we want to be doing. And I guess the main element of you know, investing is obviously to get some growth, you know, but I think people forget about that idea of getting good cash flow and getting good returns. And the power that can bring that into a super fund is immense, and especially when you've got the advantage of the tax benefits in the super side and all that sort of thing. So I guess today, if you want to give us a good rundown on, let's use an example that we've got one of our clients and they're looking to purchase an SDA property and they don't maybe have a lot of money in their self-managed super fund, or there's a lot of challenges that could be there. But let's look at the idea, I guess, and you can explain to everybody, why Supavest exists and the advantages of what you guys can provide to really broaden up that sort of client base.
Exactly. And so today we'll run through that. I'll give you a bit of a background on the size of the market, and from a B2B point of view, why I'm so excited about that and why you should be excited about that from a B2B, talking to clients out in the market and what changes are happening there. And I'll run you through how we can change people's lives, but in doing so, change your own lives, because you can now access a lot of clients that you haven't been able to talk to in the past. And at the end of it, with Safe Property, the fractional investing, I know Anthony's going to cover off some exciting opportunities around that side. So where people haven't got enough money to get into their own high cash flow property themselves, they can now partake in part of one of the ones we're building around Australia as well, and that you guys are managing. So,
Well, let's get stuck in and explain a little bit to us about it so that guys can understand it.
All right. How do I share my screen?
Okay. I believe down the bottom there's a little start sharing screen next to the camera. Is it down there? Technology, gotta love it. Even through COVID, we did all these problems, we still can't figure it out. The world of technology.
Well, leave stage, start sharing screen.
There you go, start sharing screen.
All right.
That's it.
So, share the window.
Mm-hmm.
All right, you should be able to see an afternoon with Supavest.
Yeah, can see that fine.
All right, beautiful. Now, no financial advice. It's general in nature. I'm an accountant. I'm not a financial advisor, and I suppose we've all got to be careful about that when we're talking to clients. The other part of it is the general disclaimer that I have, like understanding the biases when people want to talk to a financial advisor. Like my bias is brand new property. I think same as you guys. You got to understand what they can advise on, what personal preferences they have. Are they licensed to talk about real estate? And over 80% of them aren't. And being able to educate your clients about that is really important, because they'll go to a financial advisor, they'll get a whole lot of crap put on them about property because they can't talk about it and they don't make any money out of it. Right. So as long as the client...
I'm not allowed to say anything, but because I'm not allowed to say anything, you shouldn't do it.
Exactly. And I can't make money off you if I put you into property. That's because right. The only way I make money is if I put your money into the share market and I take a percentage of funds under management.
That's right.
So that's how they make money.
It is very hard to get honest property advice in the world. There's no doubt about it.
Very much. Yeah. So this is a quick one on how big is the market. All right. In the last quarter, September, this comes from the government website. In the July to September quarter, there was a bit over 7,500 new self-managed super funds set up. So that's 644 a week. All right. Now that's a lot. That's 1,700 members. So mum and dad and couples that have actually moved on. Total SMSFs in Australia, 611,000. Again, 1.142 million clients.
Wow.
Assets under management in September were 851 billion, June 850. So even in the last quarter that the ATO's recorded, there's $500 million worth of increase in assets under management in self-managed super funds.
It's a lot of money sitting there.
It's a lot of money. Like you're looking at $165 million a month in increase in growth. And that's a lot of that money in the last month, like that's money coming from industry super funds into self-managed super funds.
Yep.
And the majority of these people want property. Now, up until now,
would it be right to say that basically the majority of that is being held in cash right now because people just don't know what to do with it?
Yeah, see, they're still getting into property, but they're buying negative geared properties.
Yeah.
A whole chunk of it's in cash.
Yeah.
Because a lot of people still don't know what we're gonna go through here today. Right? They don't know they can build brand new high cash flow properties. But look at those figures, they are big figures, and they are people that you haven't been able to talk to up until now. All right. Now, this is a bit of a background from the psychology of the client, what they consider comfortable retirement. What does it look like, a comfortable retirement with great cash flow properties? How do we work? Not enough to own a property. Anthony's going to cover through that and what are the next steps. All right. Now, from an industry super fund and the government, they've convinced the people that the industry super funds and the share market is the way to go in retirement because that's the only choice people have really had up to date.
Yep.
But they're saying to live in retirement, by the time you retire, you need $690,000 in your super fund. You need to be in relatively good health and you need to own your own home. All right. Now that's scary because they're saying at that level, you'll live on $71,000 a year as a couple. Now, again, this you can have a look at these. This is on the government website. That's $1,374 a week in income for you to live on.
Yep.
Food and groceries as a couple. Like I don't know what you guys spend at the moment as fresh food and groceries, but they're saying in retirement you'll live on $245 a week in food and groceries. Lunches and dinners. $96. Like I don't know about you guys. I went out to dinner with my wife on the weekend. It was a little bit more than that, just one dinner.
Yeah.
Now, when you think these are people in retirement, they're not working 50 and 60 hours a week like we are now, and they've got all the free time. This is the kicker. Overseas vacations. Now, Jones, one of our BDMs, just came back from France. He's French, and he said, Raymond, I can't even buy a cheese board in France for that.
I know.
So, like Anthony, you and Tammy are overseas. What would that have got you overseas?
Actually, in Vietnam, would have got you about 4 weeks worth of food. But we're not living in Vietnam. We're living in Australia. So $37, overseas. In some countries might be all right, but once again, those countries are poor countries. Dinner over there might have cost $10. It wasn't bad, but $37 budget for overseas vacations. It's not much of an overseas vacation. You might go on the Manly Ferry. That's about as far overseas you can get.
Yeah, and see, this is the mentality that people have been convinced that's where they're going to end up.
Well, right. They don't look at the depth. They look at the top level and think, oh, that's what I've got to do, and they don't really sit down and budget and go through their numbers. And I found that quite often people, when you go through their numbers, they're shocked when they actually realise it. They don't even realise it when they're saying it.
And the challenge is, up until Supavest came along, you really couldn't have a choice on how you're going to come up with that end figure. Yeah, you can buy some real estate, established real estate, but you couldn't buy high cash flow properties. You couldn't build them unless you were paying 100% cash, and then you could buy one. Now,
you're also hamstrung by all the lending requirements on this side of the fence. How much income do you earn? How much equity you got? What the interest rates are doing? Is it handicapping your ability to be able to buy more property because the banks aren't lending as much? There's a lot of hurdles on this side of the fence that Super has a totally different realm to it.
Exactly. And so where the government says, okay, this is what you can do if you want to actually have your money last longer, work longer, reduce your expenses. Now, I don't know how you can reduce $245 a week in food down very much. Maybe one of you don't eat. I don't know. Leave less to loved ones, downsize to a lower value home. So you're literally reducing the quality of lifestyle in retirement.
Right. Which is not what
Now, it's not what you need to. Now, from a client's point of view, what do they want? Have they actually thought about it? Have they planned it? Do they want to work? Do they not want to work? Where do they want to live? Where do they want to travel? If they want to travel overseas, do they want to travel at the front end of the plane or the back end of the plane? Like my sister, my younger sister, love her very much. They're very basic people. What they want a four-wheel drive. They've got a four-wheel drive. Their idea of a holiday is pack the swag in the back and just go out bush for 6 weeks, and they're loving life.
Yeah.
Now, my wife, if it hasn't got a toilet and 3 stars, don't talk about it. So, where do people? How do you want to live? How do you want to live in retirement? Is $71,000 a year going to do it for you? I know Anthony and I were on a call last night with a couple, late 50s, and they're really excited about what we showed them last night.
Yeah.
What have they got? 300 in their super. They got some extra money in their house.
Yeah. Like if we're about to retire in 2 years. I mean, if you look at the situation, sorry?
What are they going to, with the 2 properties they're going to buy, what are they going to retire on now?
Well, I mean, it depends on. Yeah, I mean, that was the goal. They wanted to retire on 100, but it was like, as he said, I'm going to aim high and see how we go. But I mean, we believe that we can achieve, a situation for them there where they can retire on 100 grand a year, and that'll only increase over time because their debt will come down and the income will go up. So I mean, we can give them choice, and I think this is the biggest problem in everything we do, and every investor I speak to, is it's all about creating more choice for them. Because with choice, you have flexibility and you have options. And people forget that just because you own your own home, you've got super, you don't actually have any choice with that. Choice means you need more than one thing to choose from. If you've got your own home, and as that person said before, like downsize, I hear that all the time. But the problem is you're just ruining the quality of your life. All those years you work, to sell the house that you love just because you can't afford to eat, to have some more money, and this is the sad part about it.
Yeah, 100%. And that what they consider comfortable. Now, and everybody understands this, the 2 choices people have got: industry super fund, self-managed super fund. Now, the rhetoric around this, I even had a call, I was on a call today with a B2B marketer, and they said they've just set up a super fund for one of their clients, and the accountant would only let them do it because the client had 200,000 in their super fund, because the accountant is telling them you need a minimum of 200 because of the costs and everything else, which there's no legislation around that. It's bullshit. Excuse me. Like they're going on, the cost of setting it up is high and expensive, and it costs a lot to run. If you've got $150,000 in your industry super fund, you're actually spending more money than it does to actually manage and run a self-managed super fund on a yearly basis.
Because of all the fees.
Exactly. So self-managed super fund, you can, like we charge $6,900 to set up a self-managed super fund, a corporate trustee, a limited recourse borrowing structure with a corporate trustee for $6,900. Now, the clients can go to their own accountants, they can get that set up. As long as the accountant understands self-managed super funds, it'll cost them plus or minus of that as a once-off fee.
Yeah.
Then you're looking at between $2,500 and $3,500 on an annual basis to manage it, all the legal requirements for the government and tax returns and audits and everything else. So once you've got a property, it's not a big expense. All right, but that's where we're talking about self-managed, getting people to take control of their cash and build, and giving them the choice of high quality assets that they can now build inside their super fund.
Well, as I say to people, because they say to me, I'm getting this and getting that in my own super fund. It's like, well, what's the what are you investing in? They, I don't know, the super fund chooses. Okay, so you let the super fund control your financial future. Like, you don't know what they're investing in. They're just telling you we're getting this return because we're doing this, but you don't know what they're actually buying and doing in most cases. Like, unless you investigate and go into great depth, it's all pooled money that's just going into these things. It's hard to know what they're doing.
That's it. And even with self-managed super funds up until now, this is the limited choice people have been investing in: high-rise apartments, townhouses, and a small selection of land and house packages, because
Single contract.
you have to have a single contract. And why is that? The builder has to carry 100% of the cost. So even now, up until Supavest, people have been buying properties, but they've been buying B and C class stock.
That's right.
Right? They're neutrally at best they're neutrally geared.
Yeah.
They haven't had a choice.
Well, at best they're B and C. I've seen a lot of the X, Y, Z as well. You know, like, I mean, some of the stock's been rubbish because it's all they can buy. So they just think, well, I'm better buying something than nothing.
Exactly. And like, if people have had financial advice over the last 3 years, and I'll hang my hat on this, if it's been about property, it's been wrong. Right? Because if they haven't known about Supavest and the choices that they can now have in their super funds, the advisor will, as soon as they find out about what we can do, they change their advice straight away. All right. Where if you look at, we've got two choices in what we're doing. We're talking about self-managed super fund, but you guys are already talking to clients about building their wealth in the short and medium term in family trust, unit trusts, companies, sometimes in their own personal name, but their long-term asset holds what they're going to live to retire on. Sorry, what they're going to retire to live on, because we're around the right way. Unfortunately, have been held wrong, because what they should be doing, they should be holding those assets in a self-managed super fund, because as I'll show you in a few minutes, the tax benefits on that are huge. But up until now, they haven't had that choice if they're going to build it. Right, so this opens up such a big market for all of your clients. Now, this is an $890,000 high cash flow property, probably a year and a half old, this information, but it's the same numbers. So 890, 20-year loan, $2,100 income a week. Now, as you see, I'm being very conservative on the numbers. Person's 40 years old, they hold the property for 26 years until retirement. Now, if they hold that in their own personal name, they're up for $714,000 in tax. You hold it in a company, you're still paying $455,000 in tax, because you're a 30% tax rate now. And unfortunately, people are holding their long-term assets that they're going to retire on in these structures. So when they retire, they're going to continue to pay tax. You start building your long-term wealth in a self-managed super fund, and you pay 15% tax up until you retire, and 10% on capital gains if you're trading properties on that side of it. So if you look at that, you pay $227,000 tax on this example. Now that's nearly $500,000 savings in tax compared to personally, and $250,000 in savings in tax compared to a company. The kicker though is, when you retire, any money that's in your self-managed super fund, any income that's coming in, is now tax-free and capital gains tax-free. Any money that's held outside of that is up to your marginal tax rates. So where you've got clients that are making a couple of $100,000 because they're holding a couple of NDIS properties and high cash flow properties in their super fund or personally, if they're holding it personally or in a company, they're now up for marginal tax rates of 47%, compared to in a self-managed super fund, 0. Right, so the power of buying property in the right entity and the right structure is really, really important. And now you've got the ability to sell that to them every day of the week. Right? Choices, wherever you guys are building, they can now have that in their super fund. Western Australia, South Australia, wherever, whatever product, they can now build, and you can sell them a product inside their super fund that will suit their needs and desires, right, and their long-term goals. We take any two-part contract, and this is why we can do that, and the builders love us, because you can take any two-part contract from any of your builders and we turn that into a single-part contract, right? Because what they need in a super fund is what they call a single acquirable asset. It has to be a completed house. And that's still the same in the SIS Act, the legislation that controls self-managed super funds. You have to buy a single acquirable asset, and that's what we give them. The power of what we've done is we've taken the responsibility of the funding of the project away from the builder. The client pays a 35% deposit and we look after the progress payments with the builder. Now, Anthony's going to cover off safe property. That's a really exciting option for a lot of clients at the moment and how that goes. Now, this shows you what people can do. They can take their $250,000 if they've got that in their super for this example, and they can go to the bank and borrow 50% under a margin loan, which is a very risky loan, and they can turn that into $375,000 today. All right, and so they can have some control over how they're managing their superannuation in their retirement, even though that's a very risky option. Now, you look at on the property side, you can take that $250,000 and turn that into a $714,000 house and land package that you put inside your super fund that now gets paid off by your clients. So already, just with one property, we're above the benchmark of $690,000 that the government says you've got to have in retirement. So we can actually plan with people how many houses or what they can have to actually live on in retirement. The big difference between this option, though, is $690,000 sitting in the share market. What's that returning? When you compare a high cash flow property inside the super fund that gets paid off, now it's actually returning monthly rent that people can live on, and they're not having to sell down the actual asset. So in this example, that 250 turns into an 821,000 asset being cash and house that they've now got inside the super fund today. So they can literally start planning how they're going to retire, because they're not hoping they get to 690. We've actually shown them we'll get you to 700, 800 right now because of the properties that they're actually purchasing. Then safe property, that's a fractional investment. I know Anthony's going to cover more off of that as we work through. Now, how we work, you decide. My attitude is it's the client's money. Where do they want to invest it? Where can they invest it to get the best return? The builder, location, property type, it's all up to them, right? So we're not telling them what to buy. All we're saying to them is they need a 35% deposit of the single contract price, and we'll work through that one quickly in a minute. Once they've got that, we actually fund the actual construction. We fund the other 65%, and we provide that. The benefit of that is they make one payment, they sit back, the property gets built, the builder gets all their progress payments. The builders love it. It's a normal two-part construction for the builder. At completion, once the house is finished, the client comes up with the 65%, or their client super fund actually comes up with the 65% balance. They pay us the 65%, and the title gets transferred into their super fund. And now they have a completed property inside their super fund that they've chosen. Very simple, right? What we're finding, though, is our clients are going to a 70 and 80% lend of a commercial value against the property, which is giving them, in some cases, 100% finance against the single contract price. And they're putting the deposit that they use for the first property, they're putting it back into a second property and a third property as they're going through, because of the funding that goes through with the banks, right? So everybody's used to a land and house two-part construction package. So this is one of the examples that we showed the clients last night. 335,000 is land, build 662,000. Now, I'm showing you this so you understand it. When we show the clients and when you're presenting single contract properties to the client, you're literally showing them the single contract price, because to do anything else, you're actually lying to them. But this will show you the actual progress through of what a land and house package costs as a two-part and what it actually costs as a single part. Now, you're selling these every day of the week. I ask the question, how much is that 997,000 property going to cost the clients outside of super by the time they get a set of keys in their hand? Now, the answers that I get surprise me at times. A lot of people say it's going to cost them $997,000. But what they're forgetting, though, is all of this sort of stuff. Interest on the construction interest, the interest on the block of land that they're actually paid for, the stamp duty, the establishment fees, settlement fees, any add backs from the land developers, council rates, taxes, etc. In this example, you're looking at about $83,000 worth of additional costs that the client's going to spend after they've signed the contracts by the time the house is built and they've got a set of keys in their hand. So that two-part construction actually costs the client around $1,080,000 by the time it's finished. Now, that as you got it there, that's illegal to actually do in a self-managed super fund. I can't do it. And this is really important. If the clients can come and they can come to a builder and they can do this, and the builders know wiser, they just do it, they pay it. But when the client gets caught, and it's not an if, it's a when, because every year self-managed super funds get audited. When the clients get caught by the ATO that they've actually done a two-part construction inside their super fund, it now becomes a non-compliant fund. What that means is the clients get charged a 45% penalty by the ATO, and that penalty isn't against the super fund, it's against the members personally, right? And that's 45% of the asset value of the fund. So if the fund has got $1 million asset in it, that's $450,000 penalty that the members are now up for and they're liable for personally. And inside the fund, the tax rates go to full marginal tax rates. You move from a 15% tax rate up to a marginal tax rate. And the only way to fix this is to sell the property. Pay the full tax rate, pay the penalty, and start again. So the ATO are very, very serious about managing people's superannuation correctly and them not getting into risks. So that $1,081,000 two-part construction package, as it's finished, the way we do this, we turn that into a single-part contract. We charge $11,000. That's our fee. Now, we've got some additional holding costs. Now, we hold so much land around the country. We're at land tax rates, maximum land tax rates in every single state except ACT and Northern Territory. So we've got land tax rates, insurances, QSBs. So we'll have a quantity surveyor go out at every single stage of the process. We've got a bit of extra mortgage fees, some additional interest above the personal interest rate that was calculated in the previous screen, some internal admin fees, and also GST. So that's the extra $69,000 worth of holding costs under the single contract holding cost that we've got. So that goes from a $1.08 million property as a two-part into a $1.162 million property that the client can now purchase in their super fund every day of the week. All right. Now, when you've got the brochures that get prepared by your firm, Anthony has that property there that we showed the guys last night was a $1.162 million property, and that's what they see on the brochure. They look at the figures and look at how the returns to make, and now they're choosing the returns based on what they can actually do in their super fund, all right, which is a really exciting position to be in. That's more understanding the mechanics behind what goes on to turning into a two-part, because what you will get, there will be some people that say, okay, I'm paying $160,000 more for a single part contract, but they're forgetting the costs that are associated with a two-part contract every day of the week, even if they're not doing it in super. All right, so that you've got to understand that very clearly on those additional costs. Now, you guys cover this off really well anyway. Like, why are people investing? Lifestyle, security, retirement. It's the big question, and it sets down the goals about what they need to be building inside their super fund to actually support their lifestyle and the security in their retirement. All right, so we spend a lot of time in, and I know Anthony and the team do spend a lot of time with people on that side of it. Now, this example is one of my staff, and they're investing in NDIS properties and the plan that they've got as a couple. Now, they've made the decision to maximise their superannuation contributions up to the $27,500 each year to be able to benefit them even more in superannuation. Now, if you run those figures for my staff through the government website, what you'll find is they'll end up with $2.6 million worth of assets or shares in their super fund, which sounds like a good chunk of change. But what's going to happen though, that $2.6 million, by the time they get to 91, there's going to be nothing left. Because if you look here, the government says based on that, they're going to live on $159,000 a year every year, which is not a bad income. But what they're not telling you is that's $159,000 year in, year out. Now, what's happened to inflation over the last 10 years? What's going to happen if you have $159,000 today? What's that going to buy you tomorrow and 10 years' time? Are you going to have $180,000, $200,000 to have the same lifestyle? So what the government's basically saying, like if you look at this section here where the blue zone, that's where you start actually living on the government pension. But what I believe is going to happen, because that 159,000, if that's the lifestyle you start with, because of inflation, you're going to start eating into the government pension into your mid-70s, because you're going to have to start drawing down more of the capital. Like here, you're already drawing down capital every year at $150,000 income. But by the time you retire, you're not going to have anything left. Now, let's compare that to some high cash flow properties in NDIS. And this is my staff's journey that they're on. They've got one property they've built at the moment. They're actually up to their second one because they've completed this build, and they're up to their second property. Now I'll run through. Now this is being they're being a little bit extreme, but they're pushing hard. They could actually go harder than this because the first couple of properties are getting 100% finance on. But by the time they retire from 36 to 56, right, they've got 6 properties in their super fund. By the time they retire, they'll have $782,000 in their bank account. Assets, now I'm being conservative. The purchase price of those assets of $8.4 million, I'm saying at retirement, they're going to only be worth 11.3, all right? So that's not even doubling over every 10 years. It's less than that. Their income, though, is $700,000 because they've got 6 fully paid off high cash flow properties. Same example in using NDIS high cash flow properties compared to what I showed you with the $2.6 million through the industry super funds from the government website. This is now investing and building high cash flow properties and really setting up your future. Now, what you're doing here is, one, changing people's lifestyle. You're changing people's lifestyle in retirement, how they're going to retire. Is $700,000 enough? Is it too much? That's a good income. And because the rentals are adjusted by inflation each year, you're not falling further and further behind every year. But from your side, you're making constant sales because you've got the clients on a plan where you can actually change their lifestyle in retirement. But more than that, when they finally pass, you're actually leaving $11.3 million worth of fully paid off assets to their kids or their grandkids. So you're starting to work on generational wealth change while still giving people an amazing time in retirement because of the quality of income that's coming in. All right, so there's some very, very nice numbers compared to the industry super fund because you're actually planning and growing and developing their super.